Clint is here now to present to us our first pitch after the lunch break. He has a multi-asset residential opportunity zone fund that is concentrated in the Midwest. So Clint, please take it away. It's your show.
Hey, thanks, Jimmy. I appreciate you offering to have us on here, and I appreciate everyone spending a little time with us. We're the after lunch segment. So if a conservative and simple offering is for you, well, then grab a cup of coffee and give us a few minutes and we will walk you through what we're doing with Nest. We created this fund for ourselves. We did not create it as a fund, raising outside capital at first. Just me, my family, and our operator in Lexington, Kentucky. And we built it the way we've been doing rehabs for kind of a long time. There was no real thought to open it up to folks, except in 2019, some of our advisory clients had an interest in some large cap gains. So once the final rules were finalized, we opened it up to our advisory clients. And last year, we opened it up to everyone. So if you have an interest in kind of those small projects, we're very simple. We're kind of family oriented, where you can kind of always call us. We're the shop for you. We focus on Midwest areas, and everything we're going to do is pretty conservative. And that's because I've got my parents in it and I've got my clients in it. So I think it was on the first panel, they said, what does the operator have, the sponsor have to lose in this investment? And I could just have some very uncomfortable Thanksgiving dinners if things don't work out like we thought it would. So our team is not just me. We've got our advisory firm as well as the Nest employees. And but we really couldn't do it without our outside partners. And we're in the Midwest, so we kind of focus on the larger institutional partners who still have Midwest billing rates and have a focus on that OZ space. So for example, Kegler Brown is our law firm, and Andrew Dope, if any of you are looking to start an OZ fund, and he works with Ashley Tyson, obviously talk to Ashley, but he does some co-counseling work with them. So again, kind of leaders in the field. GBQ is our audit firm, and they are kind of the largest independent in the Midwest. I only have 10 minutes to speak today, so I'm going to kind of glance over some stuff, but we'll be sending PDFs out, which will have our full deck, more information about our social impact. It's something that's important to us. I'm not going to talk too awful much about it today, though, but we're looking for giving people a path to the middle class through homeownership, through down payment assistance. And also one of our operators in Columbus, Ohio, is really focused. He's got a passion for helping those who are through rehab programs and getting a career path set up. And there's some of our workers here. So again, we're going to be very conservative with everything that you see. Inherently, all OZ funds are going to have a little bit of a riskier strategy on the real estate side, and that they're all going to have that substantial improvement or original use criteria that they have to fulfill. So you can't just buy a performing real estate that's going to fart out 4% income per year. You've got to do some heavy rehab work. It's a little higher on the risk scale. And so for us, what we're doing is we're balancing that with more conservative assets within real estate. Generally, single family and smaller multifamily is the most conservative. Can be difficult to scale for large firms. But if cap rates move up 1%, our single families are going to be fine. In addition, we're looking at very stable geography. We're from the Midwest. That works for us. Clearly, San Francisco probably had much higher real estate appreciation over the last 20, but I think in the last 3, it hasn't been that well received. Within our geographies, we're looking for stable workforce, growing population, and then if we can, supply constraints as well. In addition, real estate at this level is a ground game. So you've got to be there. You've got to be talking to your different kind of workers and see the assets, and we really focus on doing that. So within those constraints, we're looking at Lexington, Kentucky, and Columbus, Ohio are the areas. I'm from Columbus, where I live. Lexington, our partner and operator, he also has money into the fund, is located there, and he's been doing this for 20 years or so. They're both university towns. They've got kind of an education background, and that's a good, stable workforce, and for lower income folks who are our residents. And in addition, Columbus is a capital city, so we've got good government. Lexington also has some government as well. As far as demographic trends, 10 years is a long time. I want that to be to my back, not to my face. So kind of looking out, what we can see is in that below the Rust Belt area of the growing Midwest, we've got 4 good growth markets: Columbus, Indy, Louisville, and Lexington. And within that, we're choosing Columbus and Lexington for a reason I'll show you here. Number one, I've got operators and boots on the ground there, but also around Columbus and around Lexington, we have the fastest growing cities. And in Columbus, they're suburbs, and Lexington, they're a little further out, which we'll talk about in a second. But the top growing cities are located in our towns, which is going to give us a good tailwind for a while. In addition, and we don't see this often in the Midwest, Lexington in particular has beautiful supply constraints. To maintain and preserve their kind of pastoral horse setting, if you've ever driven from Louisville to Lexington, you should. It's a beautiful drive. And they really want to maintain that. And they've got an urban service or urban growth boundary. And that urban growth boundary essentially says outside of that, the yellow area that you see on the map, lots can't be subdivided more than 20 acres per lot. So you really can't develop based on it. And it creates a ring where the city is now constrained in growth, and there's really not much land left. In addition, outside of that green area that you see there are a ton of conservation easements, which are essentially folks who've donated off their development rights in perpetuity. Columbus doesn't have as strong supply constraints, but we do have some zoning issues that makes it difficult for affordable housing to go in the suburbs. I'll get through there quickly. So zooming in, this is about the opportunity zone, the blue shaded area in Lexington. I'm going to talk about Lexington some today because I don't have a lot of time, but I'm happy to talk about Columbus. It's just kind of a vibrant, growing city. But Lexington is a little bit unique, and its opportunity zone is located really right in downtown. And the area that you see that's kind of the purple line is downtown, University of Kentucky, Rupp Arena, and the blue little houses are, our houses and duplexes in that area. There's a ton of redevelopment going in and about to occur there. So Rupp Arena, for example, is expanding from 80,000 square foot convention space to 700,000. So there's going to be a lot more bodies coming in. But the big one is the Town Branch Park and Trail. And right now there's a little stream that runs through the city that's effectively kind of just running under culverts, and it's nothing nice, but they're going to create a beautiful bike path with that, with splash pad at one end, and at the other end are all of our properties that we've been buying up, and we can get them relatively inexpensive. So that neighborhood is really changing. And take a look at our social impact brochure, because we talk about how we try to share some of the benefits of that neighborhood changing with the residents, both our tenants and outside folks. So with any sort of, in my mind, any sort of real estate, especially in the smaller area where there's a lot of moving parts, execution is where the rubber hits the road. So just kind of walking through what we have been able to accomplish in the last few years. So in January of 2019, we started, it was me, my parents, Jeff Moore, our Lexington operator, and we all pitched a little money into the till, lent a little money in as well because we didn't have enough, more than 470 in cap gains. And we opened it up to capital raise for our advisory clients in December 2019. And at that point in time, we had about 23 units. I believe that was 21 properties, 23 units. And you can see the status of those properties as of January of 2020. The vast majority were in inventory, kind of waiting on rehab crews. We're building up our crews. And then we can see we've now we've got 50 units, about 38 properties, if I recall correctly. And a good number of them are completed, and we've got them rented, good rent collections. And of those that are completed, we've got 8 appraised, and we've got a 23% value of those properties above our costs. So our appraisals are adding value. We want to continue doing that. I'm not going to walk through our project level financials because I don't really have the time right now, but take a look at our deck. We walk through it. The structure of our fund, we closed out our Series A last month, and we're just now opening up Series B. So it all goes into the same Nest Opportunity Fund. We'll be doing the exact same thing with Series B. A few basic terms for folks to look at. Our terms are going to be very simple, and they correlate well with a very conservative offering. So we project IRRs of about 12% annualized per year, including the OZ benefits. Our assumptions are relatively conservative. I want to continue to be friends with our investors and clients. We've got a minimum investment of 200 grand. It's a soft minimum. So if somebody has a lower cap gain and they'll continue working with us as long as we say we do what we're going to do, then we can continue working with them. Our fee structure is relatively low. We have a low preferred distribution. So our pref is 4% per year, which is relatively low. And again, we built it that way for ourselves because that's how we wanted it. We wanted to continue reinvesting our capital into the OZ space so we can continue doing good things, and also so we can get a juicier tax-free exit in year 10. So we're looking to have the highest probability of cap gains we can, not necessarily the highest probabilities. Singles and doubles all day. We're not looking for home runs or strikeouts. So I think my time is kind of coming close to a close. A couple things I'll leave you with. We're going to send some PDFs out to you all, and there are some resources I invite you all to hit us up on. My email is clint@nestopportunityfund.com, or our investor liaison, Meredith, at nestopportunityfund.com. But if you're contemplating OZs, we've got a personalized calculator where you can put in your own tax rates, your own state tax rates. In addition, we've got a webinar on March 16th. Love to have you guys there for. There's an invite as well. And then take a look at our social impact program brochure. We've got a great video from one of our operators that talks about kind of his passion and what he's trying to do. So, Jimmy, do I have another 20 minutes or am I good here?
Awesome. No, I think you're good there. I think that's a good stopping point. We got time for a few questions. If anybody has any questions for Clint, please chime in, use that Q&A tool or chat them in the chat box here. Got a comment from Paul who says, great presentation, Clint.
Thanks, Paul.
And I've got one question for you is, and forgive me if you've already covered this. I'm doing like 8 things over here at once, but could you talk a little bit about your exit strategy?
Yeah. So the thing with our assets, being in single family, and I mean, we're in smaller multifamily, but we're closing on a 32 unit this week. But everything is easier with the smaller assets that we're doing. Our substantial improvement timelines, it's not a problem to do that in 32 months on a single family rehab. Our exit plan, we've got it structured so that we could have a single family housing REIT take us out with either of our 2 footprints. And we've got it structured so that we could sell them in the retail market. And both of those would be relatively lucrative. What we probably don't want to do is to sell the whole package to an institutional investor, like someone like us, because they're just going to be very price sensitive. So we want to sell to either a relatively unprice sensitive REIT that has like a very low cost of capital, they're going to pay up, or we want to sell the individual properties to homes. Our down payment, our kind of path to the middle class program is giving folks the ability to purchase their own house from us. And we give them a little bit of a break on the purchase price if they've had, several years of good rental history. So really, everything about our strategy is relatively easy. Well, simple. When you're managing 12 crews that are dealing with single family rehab and you're trying to systemize things, that's difficult. But in particular, that the exit is going to be relatively easy for our asset class, Jimmy.
Good. One final question. Eric wants to know, what's your minimum investment?
Eric, our minimum is 200 grand. Like I said, we're relatively flexible on that. We've got some legal requirements that limit the number of investors we have. And so we want to spread those fixed costs over more assets, basically. But if someone's got 150 in cap gains and they like the fund, and they come on board and they kind of like how we communicate with our partners, which we do with a letter on a quarterly basis. We have webinars once a month. Then the handshake is kind of like, as long as we do what we say we'll do, the next time you have a cap gain, you'll kind of true us up to that 200 number. Because clearly we can't have, $99,000, $30,000 investments. It just doesn't make economic sense. But great question.
Excellent.
I'll be available at the happy hour. In addition, feel free to chat me up at any point in time. Happy to answer questions.
Fantastic. Yeah, that happy hour starting at 4:30 p.m. Eastern time. We'll get you more information about that as the day starts to wind down. Clint, thank you very much for joining us today. If you're interested in learning more about the Nest Opportunity Fund, please visit their website at nestopportunityfund.com, or you can email clint@nestopportunityfund.com. Clint also mentioned that he has a lot of PDF resources available. I actually posted links to all of those in the chat panel. So if you're interested in learning more, you can click those links now and start reading. But Clint, otherwise, I think that does it for your time today. Thanks for joining us. I appreciate it.
Thanks, everyone. Thanks, Jimmy. And thanks for your time.